Fire insurance. Talk about the definition of fire insurance, essential principal feature elements of fire insurance, characteristics of fire insurance, the nature of risk involved in fire waste, define fire waste or loss, classification of fire insurance, prevention of fire loss. Definition of fire insurance. Fire insurance is a contract by which the insurer agrees to make good for any loss suffered by the insured through damage or destruction by fire. Fire insurance is a device to compensate for the loss consequent upon destruction by fire. According to Insurance Act 1938, Section 2/6b, fire insurance business means the business of affecting otherwise than incidentally to some other class of insurance business contracts of insurance against loss by or incidental to fire or other occurrences, customarily included among the risk insured against in fire insurance policies. According to Aman Mishra, fire insurance may be defined as a contract whereby one party undertakes in exchange of a premium to indemnify the other against loss or damage caused to a specified property by fire during a particular period to the extent of a definite sum. According to Hartley, fire insurance in which the sum insured becomes payable on the happening of a fire. From the above discussion, we can say that fire insurance is a cooperative device to share the loss, since fire is a good servant but a bad master. Essential principal feature elements of fire insurance. All the features of a general insurance contract are also applicable to the fire insurance contract. There are two types of principle of fire insurance: the elements of general contract, the elements of special contract. The elements of general contract, according to the Contract Act 1872, a valid contract must have the following essential: offer and acceptance. The first element of any type of insurance contract is to be offered to be insured person by the insurer. The offer for entering into a contract may generally come from the insured. Second one, the legal consideration. The insurance contract starts on the basis of legal consideration named premium. The insurer undertakes the risks of the policyholder under legal consideration of premium. Third one, competencies of parties. Every person is competent to contract if he or she has the following quality: who is এখানের মধ্যে কিছু সাব কন্ট্রাক্ট আছে যেমন who is the age of majority according to the law, who is of sound mind, who is not disqualified from contract by any law, a minor is not competent to make any contract, free consent. Parties entering into the contract should enter into it by their free consent. The consent will be free when it is not caused by coercion and undue influence. General contract element গুলো হলো fraud, misrepresentation, mistakes. Legal object হলো এখানে একটা legal object আছে স্যার, in order to make a valid contract the object of agreement should be lawful. The elements of a special contract. Number one, insurable interest. Insurable interest is the main subject matter of insurance contract. The insurable interest is the pecuniary interest. The insurable interest must be presented at the time of contract and at the time of loss. The following conditions must be fulfilled to constitute as insurable interest. Number one, they should be a physical object capable of being damaged or destroyed by fire. The object must be subject matter of insurance. The insured must stand in such relation with subject matter as recognized by law. Second one, utmost good faith. Insurance contract must be based on the important principle of utmost good faith. Both parties must disclose all material facts. In an insurance contract, there should be no concealment, mispresentation, or fraud about the material fact. Both parties of the insurance contract must have the same mind at the time of the contract. Principle of indemnity. All insurance contracts except life insurance are contract of indemnity according to the principle. If the insured property is damaged due to specific event, the insurer will compensate the portion of damage. For special contract, এটা দেখেন doctrine of subrogation, warranties, proximate cause. If the insured property is totally damaged and the insurer pays full indemnification, the ownership of damaged property will be transferred to the insurer. This is called the doctrine of subrogation. Warranties. There are certain conditions and promises in insurance contract which are called warranties. The contract can continue only when warranties are fulfilled. If the warranties are not fulfilled, the contract may be cancelled by the other party. Proximate cause. Proximate cause is the immediate cause and not the remote cause is to be considered. The real cause of the loss is insured. The insurer is liable to compensate the loss, otherwise the insurer may not be responsible for the loss. Characteristics of fire insurance. Contract of indemnity. Fire insurance is the contract of indemnity. The insurer is liable only to the extent of the actual loss suffered. If there is no loss, there is no liability, even if there is a fire. Contract of utmost good faith. Fire insurance is a contract of utmost good faith. The policyholder and the insurer must disclose all the material facts known to them. Duration of policy. Fire insurance policy is made for 1 year. The policy can be renewed according to the terms of the policy. The fire policy, the contract of insurance is embodied in a policy called the fire policy. Such policies cover specific properties for a specified time. Interest. A fire policy is based on only if the policyholder has an insurable interest in the property covered. Such interest must exist at the time when the loss occurs. Rule of subrogation. In case of several policies for the same property, each insurer is entitled to contribute from the others. After a loss occurs, payment is made. The insurer is subrogated to the rights and interest of the policyholder, and insurer can reinsure part of the risk. Conditions. Fire policies generally contain a condition that the insurer will not be liable if the fire is caused by riot, civil disturbance, war, or explosion. The nature of risk involved in fire waste. Nature of risk, hazard in fire waste or loss are given below. Physical risk or hazard, moral risk or hazard. Physical hazard, moral hazard. দুটো waste আছে fire. Physical hazard. Physical hazard refers to the inherent risk of fire in the property which may occur due to inflammable nature, construction, artificial lighting and heating, lack of extinguishing apparatus, use of property, etc. It is not caused by the insured person. Second one, moral hazard. Physical hazard depends upon property, but moral hazard depends upon man. In this case, the property may be set on fire by the owner or by any person with his willingness, carelessness and lack of sense of duty may also increase the fire waste or loss. It is caused by an insured person or enemies. Definition of fire waste. Fire waste or fire loss means to compensate for the loss consequent upon distribution by fire. It is a well-known fact that the fire caused huge losses every year. Classification of fire insurance. Valid policy, unvalid policy, specific policy, floating policy. Valid policy. In case of valid policy, the value of the insured property is determined at the inception of the policy. The insurer pays the total admitted fire value irrespective of market value of properties. So the market value of insured property is not considered in this case. A valid policy is one under which the insurer agrees to pay a specific sum irrespective of actual loss suffered. Unvalid policy. Valuable policy is that policy where the claim amount is to be determined at the fair market price of the damaged property. It is just the opposite of the valid policy. The amount of loss is determined in accordance with the fair market value at time of occurring the loss. So market value is considered in this policy. A specific policy is that policy where a specific sum is insured upon a specific property in case of a specific period. The whole of the actual loss where it is payable does not exceed the insured amount. Floating policy is that policy which is taken to cover one or more kinds of goods at one time under one sum assured for the one premium relation to the same owner. The policy is useful to cover fluctuating stock in different localities. আজকের মতো এখানে এতটুকু থাকুক।